So picture this. You're sprinting through an airport terminal.
Oh yeah, we've all been there.
Right. And you glance up at a TV screen near the gate, and the breaking news banner is just bleeding red. Oil just crashed 5% in a single day.
Twitter is instantly melting down.
Completely melting down. And the broader market, acting almost entirely on reflex, just instantly files that event under one neat, tidy label, an oil shock.
Yep. Energy stocks plunge, maybe the defensive sectors catch a bid, and the narrative just writes itself.
And everyone nods along, right? Everyone assumes they understand exactly what just happened.
Well, it is incredibly comforting for investors to have that kind of binary trigger. People desperately want clear cause and effect. I mean, oil goes down, energy stocks go down, end of story.
But it's not the end of the story.
No, not at all. When you dive into the actual data, and we have an incredibly robust set of sources for this deep dive, tracking 33 years of daily oil market data, the universally accepted narrative just falls apart.
It shatters.
It really does. It is fundamentally incorrect. The market treats every major move in oil as the exact same type of event, and the data proves that doing so is a massive mistake.
The sources we've gathered take an absolute sledgehammer to that narrative. We are looking at over 8,300 trading days.
From 1993 all the way through 2026.
Right. And the core thesis that jumps out of this massive data set is a single sentence. It completely rewired how I view financial media. And I am going to hammer this phrase relentlessly today.
You have to.
Not all oil shocks are the same.
That is the cornerstone of this entire analysis. Not all oil shocks are the same.
So what does the data actually reveal?
It reveals there are exactly 3 fundamentally different types of oil shocks. They are mathematically distinct, they're driven by different forces, and they trigger entirely different reactions underneath the surface of the stock market.
And if you don't know the difference...
If you are adjusting your portfolio or trying to understand the macroeconomic climate, and you don't know which of those 3 types you are dealing with, you are trading blind.
Trading blind, that's a highly dangerous place for any investor to be.
Absolutely.
So our mission today is to pull back the curtain. We're going to break down these 3 distinct types of shocks, explore why they produce completely opposite outcomes for the exact same stock sectors, and unearth this hidden mathematical engine that dictates whether the market panics or simply shrugs.
Let's get into it.
But to start, we have to actually define what an oil shock is. Because as the data shows, these 3 types almost never overlap.
Right. Let's categorize them. The first class is what the research calls a front-month price shock.
Okay, front month.
Yeah. These are the classic headline grabbers, the ones you see on that airport TV. We're talking about the top and bottom 2% of daily moves in the WTI crude front-month futures contract.
And to cut through the jargon for a second, that's really just the benchmark price to get a barrel of oil delivered next month.
Exactly, the immediate price. On average, a shock in this category means a massive 7.8% spike upward or a 7.6% crash downward in a single trading session.
Very loud, very aggressive, highly visible. I mean, every trading algorithm and retail investor sees it immediately.
You can't miss it. But the second class is virtually invisible to the average headline watcher. These are curve shocks.
Curve shock.
Yeah. A curve shock is a sudden, extreme change in the oil futures term structure.
Yeah.
So this is the spread between the front-month contract, again, oil delivered next month, and the second-month contract.
Got it.
When that spread violently widens or collapses, it means the market is rapidly shifting its underlying assumption about near-term physical supply versus slightly longer-term supply.
So it's essentially the market repricing the premium people are willing to pay for immediate certainty.
Precisely. It's entirely structural. It doesn't always make the evening news.
Okay, so that's 2. What's the third?
The third class is physical supply disruptions.
Oh.
This is the real-world chaos breaking the math.
The messy stuff.
It's very messy. We have a curated list in the sources of 17 major historical episodes. We're talking wars, hurricanes, massive OPEC production cuts, drone strikes, real events that physically disrupt the actual extraction or transit of barrels of oil.
Okay, so we have front-month price jumps, we have invisible curve shifts, and real-world physical chaos.
Those are your 3.
And if these represent completely different economic realities, they must ripple through the stock market differently. But I want to bring up the data point that literally stopped me in my tracks when I was reading the sources.
I think I know which one you mean.
Out of those 8,317 trading days, how often do you think these three things actually fire at the same time?
A rational person would assume all the time, right?
Yeah. You'd assume a literal war would trigger a massive price jump, which would instantly work the futures curve.
But the data completely destroys that assumption. Out of 33 years of trading, there were only 11 days where all three shocks fired simultaneously.
11 days.
11 days out of over 8,000.
That is wild.
It is. Most of the invisible curve shocks happen without any extreme front-month price move at all. And a surprising number of physical disruptions happen without warping the curve. They are essentially completely distinct phenomena.
Let me put an analogy on this because it helps clarify things. Looking only at the front month price of oil on your screen, that airport TV is essentially like looking at a single thermometer to forecast a massive storm.
Oh, that's a great way to look at it.
Right. You see the temperature drop 10 degrees and you think, okay, I know exactly what the weather is doing, but you are entirely missing the barometric pressure dropping, which is the curve shock.
Right.
And you are completely missing the actual Category 5 hurricane making landfall, which is the physical disruption.
And if you are trading off just that thermometer, you were ignoring the most important instruments on the dashboard.
And the consequences of doing that are pretty severe.
Very severe. Because these three shocks represent fundamentally different supply and demand environments, the stock market's reaction to them isn't just, slightly tweaked. It completely reverses.
Which brings us straight into the sector heat map provided in the sources. This is where you see what trading blind actually looks like in practice. Let's look at the energy sector.
The most obvious proxy for oil moves.
Exactly. When a curve steepening shock hits, meaning that invisible shift in the term structure signals tighter future supply, the energy sector becomes rank 1. It is the absolute best performing sector out of all 9 major segments of the S&P 500.
It dominates. But if you experience a front-month down shock or a physical supply disruption, that exact same energy sector plummets to rank 9.
It goes from first to worst.
The absolute worst performer. You have the exact same collection of stocks producing completely opposite outcomes, depending entirely on which of the three shocks triggered the move.
So why does that flip happen so violently? Because, on the surface, an investor might assume any disruption is good for oil companies, right?
It comes down to the mechanism of the shock itself. A curve steepening means the market expects future supply to be heavily constrained, but the price today hasn't spiked enough to destroy current consumer demand.
So they hit the sweet spot.
Exactly. Energy companies suddenly gain massive future pricing power without an immediate panic. So investors pile into the sector, pushing it to rank 1.
But a front-month down shock is different.
Entirely. A front-month down shock is an immediate reflection of panic or a sudden demand collapse right now. Future pricing power just evaporates, and the sector gets crushed down to rank 9.
The numbers attached to that swing are just massive. The data shows a 340 basis point spread in how energy performs against the broader market depending on the shock type.
340 basis points.
Yeah, and to put that in plain English, that is a massive 3.4% gap in how your portfolio performs on a single day, just based on the type of shock.
It's huge. The sector outperforms the broad market by 1.7% on up shocks and underperforms by nearly 1.7% on down shocks.
And the reshuffling doesn't stop at energy, does it?
No, look at the utilities sector. Across the 5 different subtypes of these shocks, utilities jumps from rank 2 to rank 1 and stays at rank 1.
It's just a total reshuffle.
The market rotation underneath the surface is extreme. In fact, the dispersion of returns across different sectors, the mathematical gap between the day's best and worst performing sectors, it actually doubles on shock days.
It doubles?
Yes. It jumps from about 0.7% on a normal, quiet trading day to over 1.5% on a front-month down shock day.
Okay, so let me put myself in the shoes of a listener who holds a fairly standard diversified portfolio.
Okay.
An oil shock hits the news. The broad index, the S&P 500, might barely move on the surface. Maybe it's down a fraction of a percent. But underneath the hood, my specific sector holdings are being violently scrambled.
Yes. The winners and losers are being rewritten in real time, and the headline isn't telling you why.
Because oil doesn't just move the index.
No, it rips right through the cross-section of the entire market. If you're allocating capital or deciding to rebalance based on a headline oil price drop, but you don't realize you are actually in the middle of a curve steepening shock instead of a physical disruption.
You're going to make the wrong move.
You will make the worst possible move. You will likely sell the very asset that is mathematically positioned to be rank 1.
Wow. Okay, so the type of shock clearly dictates the market's reaction. But as we dig deeper into these sources, there is a secret second layer to this data.
The environment.
Right. It is not just the shock itself that matters, it is the broader economic environment the shock happens to land in. The mathematical engine hidden beneath all of this comes down to two concepts that the average retail investor has probably never encountered.
Contango and backwardation.
Contango and backwardation.
Those two concepts define the underlying health of the oil market. Let's break them down.
Please do.
Contango simply means the market is oversupplied. Near-term demand is incredibly weak, so the price of oil today is actually cheaper than the price of oil promised for delivery in the future.
So, practically speaking, what does that look like?
The physical reality is that there's too much oil sitting around, and producers are essentially paying a premium just to store it.
Okay, so contango means a glut, weak demand.
Yes, and backwardation is the polar opposite.
Tight supply.
Extremely tight. Backwardation means physical supply is incredibly tight. The market is screaming for actual barrels of oil right today. Because of that desperation, the front month price trades at a massive premium to future months.
It's an immediate need.
Exactly. Over our 33-year data sample, the market has spent about 66% of the time in the oversupplied contango state and 34% of the time in the tight supplied backwardation state.
And the performance gap between those two states is, I think, the single most valuable piece of insight in this entire deep dive.
Staggering.
Because during that 34% of the time when the market is in backwardation, when supply is tight and the market is desperate for oil energy stocks, deliver a staggering 19.6% annualized return.
Almost 20%. Compare that to a mere 9.7% annualized return during contango.
So energy stocks perform literally twice as well when the curve is in backwardation.
Yes. But the fascinating part is how the broader market reacts.
Right.
The S&P 500 flips the script entirely. It performs significantly better in contango, delivering a nearly 13% annualized return compared to less than 9% in backwardation.
Which honestly makes intuitive sense mechanically. I mean, if you are holding an energy company, you want supply to be tight so prices remain high.
Sure.
But if you are holding the broad market tech companies, consumer goods, manufacturers, you prefer contango because an oversupplied oil market means lower energy input costs. That pads corporate profit margins.
Exactly. But the real superpower here is how knowing the curve state completely changes the meaning of breaking news.
Oh, this is fascinating. Walk us through that.
A headline that reads, "Oil price drops 5% means two wildly different things depending on the curve."
Okay.
If oil drops during contango, it confirms a deeply pessimistic story. The market is already oversupplied, demand is weak, and prices are still falling.
Right. Things were bad and now they're getting worse.
Exactly. The market hates that confirmation. In that scenario, the S&P 500 drops 1.0% on average, and energy drops 2.6%.
But if that exact same 5% price drop happens during backwardation, the reaction is entirely different.
Because it contradicts the physical reality. In backwardation, supply is tight. A sudden price drop doesn't make sense in that context, so the market assumes it is a temporary glitch rather than a structural failure.
Not just brush it off.
The market practically ignores it. The S&P barely moves, dropping just 0.2%, and energy only drops 2.3%.
To synthesize this into a real-world scenario, I was thinking about this like a retail store slashing prices on its merchandise.
Oh, that's a good comparison.
If you walk into a store and see a massive discount rack filled with winter coats that no one wants to buy, that is contango. The price cut signals the store is in deep financial trouble, demand is dead, and investors should be terrified.
Right. The price cut in that scenario confirms the underlying weakness of the business model.
But if there is a sudden one-day price cut in a store that is completely sold out with customers lined up around the block, that is backwardation. The store is fundamentally incredibly healthy and demand is off the charts. So a quick dip in price is just a promotional blip. It doesn't mean the store is failing.
It just means you had a weird Tuesday.
Exactly. The takeaway here is that you shouldn't even look at the headline price of oil until you've checked the inventory in the back room. The curve dictates the truth. The headline is just noise.
Context dictates everything. You cannot trade a price drop without knowing the inventory reality. Relying solely on the front month price is, once again, trading blind.
Okay, so we have established that the curve state is the hidden mathematical engine of oil shocks. But we have to address the third class, physical supply disruptions.
The chaos factor.
Because if the curve is the math, Physical disruptions are the unpredictable, real-world hammer that shatters the math. The sources lay out 17 major physical disruptions, and the primary takeaway seems to be that they completely break the rules.
Oh, absolutely. Physical supply disruptions are the ultimate proof that not all oil shocks are the same, mostly because they highlight the sheer inconsistency of reality. Our researchers curated events ranging from the 1990 Kuwait invasion through Hurricane Katrina, all the way to the 2020 WTI negative storage crisis. And there is no unified theory of how the market reacts.
No two episodes are alike.
No two episodes are alike.
I am looking at the list of physical disruptions, and the contrast is glaring. Let's talk about the 2019 Saudi Aramco drone attack.
A huge event.
This was a massive, highly televised, fiery strike on the world's most critical oil processing facility. Half of Saudi Arabia's production was knocked offline in an instant. The facility was literally on fire.
And WTI crude prices spiked dramatically.
But the broader S&P 500 barely moved. The cumulative return was practically flat. Why did the market ignore a literal explosion at the world's biggest oil facility?
Because the stock market is a forward-looking pricing mechanism. It quickly assessed the Aramco attack as a temporary, contained disruption.
Meaning they knew it would get fixed.
Right. Saudi Arabia had vast strategic reserves to cover the shortfall. The damage was repairable, and the oil would eventually flow again. It didn't signal a permanent structural break in the global economy.
But then you look at 2022 with the Russian invasion of Ukraine. Oil surged again, but this time the broader market absolutely crashed.
Because the mechanism was completely different. The invasion of Ukraine wasn't a temporary facility outage. It was a sustained geopolitical shock that fundamentally altered global energy supply chains indefinitely.
It wasn't getting fixed in a week.
No. It triggered massive structural inflation fears across every sector of the economy. The market couldn't just assume the damage would be repaired.
And to make it even more complicated, you have the 2020 Saudi-Russia price war.
Which happened right as the COVID lockdowns were freezing global travel.
A completely unprecedented moment.
WTI crude crashed by more than 30% in a matter of days. The S&P 500 crashed simultaneously. You had a massive OPEC supply glut colliding head-on with
an instantaneous collapse in global demand.
Exactly. It was the worst possible combination of contango and physical disruption.
Okay, I have to push back here because this feels incredibly frustrating for an investor. A massive drone attack happens, the facility is quite literally on fire, and the stock market yawns.
Yeah.
3 years later, a different geopolitical event happens and the market crashes. Doesn't this prove that trying to trade the breaking news on physical oil shocks is entirely a guessing game? How can anyone predict if the market will panic or shrug?
The unpredictability is exactly the insight.
How so?
The goal isn't to flawlessly predict an inherently chaotic geopolitical event. The goal is to recognize that a physical disruption is a fundamentally different beast than a front-month price shock or a curve steepening.
It's its own category.
The data shows that the dispersion of sector returns is actually lower during physical shocks, but the broader uncertainty is infinitely higher.
Because it takes time for the market to actually digest what a physical event means for long-term supply. It's not an algorithmic reaction to a math change. It's humans trying to calculate the geopolitical fallout.
Exactly. A physical shock plays out over weeks or months. If you react to a breaking news alert about a supply disruption by simply shorting the market because you think, well, oil shocks are always bad for stocks, you are relying on a broken playbook.
It just doesn't work.
Sometimes it is catastrophic, sometimes it presents a massive buying opportunity, and sometimes, as we saw in 2019, it is entirely irrelevant to the broader equities market.
This has been a massive paradigm shift. Let's bring this all together for you, the listener. What is the fundamental operational takeaway from analyzing 8,300 days of trading data?
The takeaway is that your diagnostic tools need an immediate upgrade. We started this deep dive by noting that investors treat oil shocks like a single monolithic event.
And we now know there are 3.
Front-month price shocks are the loud, headline-driven events that aggressively and often temporarily rotate money in and out of the energy sector.
Right.
Curve shocks are the invisible term structure shifts that dictate the true underlying health of supply and demand, deciding whether energy is rank 1 or rank 9.
And physical disruptions are the real-world chaos events that require deep geopolitical context rather than a quick trigger finger. I promised we would hammer the core thesis, and here it is one last time. Not all oil shocks are the same.
They absolutely are not.
If you are sitting there managing your own money or just trying to understand why the macroeconomic picture looks the way it does, and you only look at the front month price of crude on your screen, you are missing the curve.
You are missing the physical contest.
You are looking at the thermometer while the hurricane blows your roof off. And you are trading blind.
You have to look at the entire dashboard.
But before we wrap up this deep dive, there is one final, slightly unsettling puzzle buried at the very end of our source data.
Oh, the correlations.
Yeah, it's something for you to mull over. We spent all this time analyzing how stocks react to different types of oil shocks, but the data shows that the baseline relationship, the 60-day rolling correlation between oil and equities, is not a constant law of physics. It shifts dramatically across decades.
The historical variance is staggering. During the 2008 financial crisis, oil and stocks were perfectly positively correlated. They crashed together in lockstep.
Right.
But from 2012 to 2014, they completely decoupled.
Yeah.
The correlation sat near absolute zero. The two markets stopped talking to each other entirely.
And then in 2020, they violently recoupled again. So we now know how to diagnose the three different types of oil shocks. We know the mechanisms behind contango and backwardation. But knowing that the foundational relationship between oil and the stock market randomly decouples and recouples over decades, what happens to your portfolio if the next massive physical supply disruption hits exactly during one of those rare historical windows where stocks and oil have completely stopped talking to each other?
It's a terrifying thought.
Think about that the next time you see a red banner flashing on your screen.